Hello, long-term investors. I'm L.A. Little, and I want to take some time here to address all the new members as well as the existing members with respect to how to get on board, how to get your portfolios to mimic those that you see here on the retirement service, and then also to talk in general about where the market is and what it's doing. So let me first talk about how to get on board. The easiest way to get on board is to slowly get your portfolio to look like that which you want to mimic. In other words, there's three portfolios. There's a conservative, there's the balanced, and then there's also the aggressive. So if you want to be like the aggressive, how do you get there? Or if you want to be partially aggressive, partially balanced, how do you get there? Let me address that first. And if I pull over the aggressive portfolio, right, it's situated currently with quite a bit of it in cash. You've got roughly 48% in cash, and then the rest of it is in equities, and it's split equally, all domestic equities, SPY, QQQ, and AIWM. Now, how do you want to get to this? Well, incrementally. It's always incrementally. You don't do everything at once. And so if you wanted to move directly to this portfolio and get your portfolio to mimic the aggressive one, what you would do is you would use each day where you see weakness, and you would incrementally add to the portfolio, your portfolio, to mimic this one. So in other words, on day one, if the market's weak, I might add 1/4 of each of these and do that 4 different times until I'm fully invested. Now the other piece of this is, where is LA going? In other words, what am I thinking? For example, if I'm thinking about selling some of these, then you don't want to move to a fully invested position because I'm thinking more weakness might be coming. More risk is on the table. And with respect to that, and as a refresher, right, this retirement service, if you come down here to how to outperform long term, this retirement service is not about trying to time the market perfectly. What it's interested in doing is just limiting losses on the downside, right? Limit the losses on the downside and stay reasonably fully invested on the upside. And if you do that, over time, you will outperform with a lot less risk and not with those huge drawdowns. Avoid the huge drawdowns and just stay invested most of the way, most of the time. That's the ideal of the portfolio. Having said that, where are we now? Well, with these huge drops to begin the year, and I've got the S&P 500 up, right, we've actually done quite a bit of technical damage at this point. Now, I do expect we'll probably get a bounce, but that doesn't mean that we're going to just go right back up to the highs or even potentially get close to the highs. In neoclassical, there's concepts of swing point lows. You can see them marked here with the L's. If I come down into here, there's 2 swing point lows that we broke on this particular bar. Once we broke them, we got the escalation. That doesn't always happen. In other words, we don't always get the escalation. That escalation typically takes place as a result of breaks on multiple time frames. So in other words, on the weekly chart, when we break a swing point low on the weekly, which is this swing point low, in conjunction with those swing point lows we just saw on the daily chart, that's when you can get the escalation, and that's where we are right now. We're getting that escalation on the downside. There's nothing to say that we are through. In other words, we broke this swing point low. That gave us the escalation to the downside, and that escalation could continue right into this high volume low. So in other words, we probably somewhere over the next few weeks are going to try and test that low and try to break that low. Now that's on the weekly time frame. The big thing you want to avoid is breaks on the monthly time frame. So let's look at a chart of the monthly. And if I pull that one up, here's the S&P on the monthly. This low is not a swing point low. It takes 6 bars to make it one. In other words, if we get through January without testing this low, that will become one, and that price point is 1867. Barring that, in other words, if we do test it, The next swing point low below us is 1820, not that far away, 47 points. So in other words, we're about 5% from that swing point low. If we were to break that swing point low, that would change the trend from bullish, which it's been reconfirmed bullish multiple times now, on the way up. These time frames do not change very often. In fact, they change very infrequently. And so this one has been in effect 5 years. If we get a transition, if we break this swing point, we do not want hardly any equity exposure. All right, because the probabilities of us actually continuing lower are much greater. And so that's kind of the line in the sand when you start looking at it. When I say break, that means you get under it, you stay under it for the month. At the end of the month, you're still there. That's a break. That trend transitions. It doesn't say it might not bounce after. Matter of fact, it's fairly likely it will bounce, but the odds of it coming back lower are higher, and that's the typical big drawdown you don't want to be caught in. And so that's where we're at. We do not know if this is going to happen. What we do know, though, is that it's starting to happen on the small caps. So if I bring up the small caps, the Russell 2000, and if I pull it to the monthly, it's almost there. It's only 0.5% away. If we get a break on the Russell, that would mean that we don't want to be in the Russell, and in our case the IWM, which is the ETF that mimics the Russell. It would also say that the probabilities associated with the other markets are greater that they're going to break down. So in other words, we're right at the point where we're about to get the sort of test that's going to tell us if this whole process that's been in place has been distribution. In other words, the smart money, so to speak, is selling into these highs on the expectation that the price points are going to come lower and lower and lower. And they don't want to be holding that inventory. And so right now, if you ask me where the markets are and how much risk do I want to have on, I'm beginning to want to have less and less risk, not more. And so getting back to the whole question of what you should be doing in your particular portfolio, if you wanted to mimic those that I have and you're just starting out, you do not want to be rushing into these positions. If you have zero equity exposure, then yes, you can make some small purchases incrementally on down days, just like last week. If you have maybe half this exposure, then you probably don't want to put any more on until we decide in the next few weeks whether the risk is increasing and I will be selling more of this. So it's always a function of where we are and where we're heading, in terms of when you're starting up. So the simple rule right now is if you have no exposure on, yes, you can add some exposure. Maybe as much as half of the exposure that you see on these positional portfolios at this particular point in time. And that's true not only on the aggressive, but on the balance where you actually have a little less exposure, and also even on the conservative, where there's almost no equity exposure at this particular point in time, only 20%. So that's the rule of thumb at this particular point, given where things are and where they look like they're going. For new members, hopefully that addresses your questions. For existing members, and for, of course, the new members as well, this is a point where we're going to find out whether the markets really have topped out or haven't. There was a lot of risk coming in last year, or you could see it coming. At this particular point, it's continuing to develop that more bearish bias. And so probably in the next month, we will probably have some sort of a determination. If it's going to break to the downside, it will probably do so. And we'll have to judge it. With neoclassical, we don't try to project 6 months out. We look at it month to month. You can't see farther than a couple months. And as the market tells us what to do, then we start to do those things. We try to use strength to sell, but in some cases, you don't get out of everything prior to something happening, and you have to adjust and reduce risk even at lower levels. And if that's the way it works, that's what we'll do. At this particular point in time, I think we want to watch that Russell. That's the clue right now. See what it does, and by the end of the month, we'll have a pretty good clue as to what we should do. If that doesn't answer your questions, then you can write me and I'll try to help you individually, but hopefully that will answer most of the questions that are out there at this particular point in time. Thank you for joining, and thank you for being a member, and I will talk to you next time.